welcome to Bloomberg Quint. You're watching the fine print. A few mounds of rice from paddy that is harvested from a small piece of land would suffice for an elephant. But what if the elephant itself enters the field and starts eating? What it eats would be far lesser than what it would trample over. Finance Minister Nirmala Sitharaman quoted this wisdom from Tamil literature as she started to announce the tax changes through Budget 2019. My colleague Harsha Subramaniam explained this to me to mean that if the government becomes too aggressive in collecting taxes, it will result in a far higher damage compared to what it can collect with a judicious approach. So, does the fine print of the finance bill live up to this wisdom? To answer that, I have with me Sudhir Kapadia of EY and Mukesh Butani of BMR Legal. Mr. Butani, Mr. Kapadia, welcome to the fine print. Mr. Butani, let's dive right in and look at some of the tax revenue numbers. Are there enough means in the budget to support the tax revenue growth that the government has projected? And I'm not going to quote the percentage number because I know you have some thoughts around what should be taken as a base to calculate the revenue growth that the government is talking about in the finance bill.
Well, if you look at the revenue side of the budget, the net revenues, the net share revenues of the central government, they have projected only an 11% increase. But the base for the 11% increase is the revised estimates that Finance Minister Goyal presented in the interim budget early this year. But there is a bit of an incoherence with the overall revenue figures, because if you look at yesterday's economic survey that was presented, the economic survey carries a figure which is called the advanced collection of taxes. Now, these are the advanced collection that were made in the financial year ending March 31, 2019. Now, assuming barring a certain classification issues, if the tax collections up to March 31, 2019 as recorded on the 5th of July 2019 are correct, I'm a bit worried because there is a difference between the base of the revised budget estimates and the figures that were presented in the economic survey. Now, if you take the collections that have actually happened, and that should be taken as a base for the purposes of estimating the revenues for 1920, then you're really looking at a 20% increase in the revenues. Now, there are two possibilities. Assuming that that figure of tax collection is correct, I think 20% estimation of increase in revenues is clearly a tall order. But even if that figure is not correct, and in the course of presenting the final estimates of tax collected, I can't imagine that we would get to the revised estimate targets for 18-19. In which case, you're clearly looking at an overstatement, at least insofar as the budgeted revenues for 1920 is concerned.
Okay. Mr. Kapadia, do the numbers look ambitious to you?
No, the point I would like to make is that, we'll have to look at the actual collections for FY19, I agree. But even if assuming that there is, let's say, a slippage, as Mukesh seems to point out, the reality is that if I look at the target for 1920, and I've said this before in our own discussion of EY, I have never seen a more realistic projection of growth. The reason I say this is if you see the growth as per the revised estimate for 18-19 overall, it's 17% gross tax revenue. What we are now seeing here for 1920 is less than 10%. Which is a very modest figure, albeit on a higher base, no doubt, but a very modest figure. Now, when I look at direct tax and then indirect tax, let's spend a couple of minutes on the composition.
Sure.
If I look at indirect tax first, the growth projection is 7.4%, including customs.
Okay.
Which by no means is adventurous. And if I exclude customs, it's 5.7%. What is interesting is corporate tax and personal income tax. Corporate tax growth is 14% projected for next year, arguably aggressive because Actually, you have reduced rates for many more companies.
I was just going to come to that, yes.
And curiously, personal income tax growth 7.6% despite the
high surcharge
high
that
surcharge
has come in.
Yeah. So there's a bit of a, I'm in a quandary here. Why would you project such lower personal income tax?
Because maybe to the end of the year saying that, hey, look, we've done a fabulous job of raising more revenue than we estimated.
Well, that would be every planner's delight, even in the private sector, that you and Mukesh will relate to that you project less and you achieve more. But I must say that all I'm trying to say is the glide path, the trajectory. We can, and Mukesh is right that what are the actual numbers we have to see for last year. I agree. All I'm trying to say is that I personally think that the projections which are put in the budget papers, actually, they may not be conservative, but they are realistic. They certainly don't look as adventurous as sometimes we have seen in the past. And I'm hoping that as a consequence of this, we will have some respite, particularly in Q4, if all things go well, in this very aggressive tax collection measures which we see, particularly on corporate taxpayers. So that's really the sum and substance.
So if I put together what both of you have said, Mr. Butani is saying that, look, the actual tax that you've collected, if you take that as the base and then look at the projected numbers, the growth looks on the higher side. It's
it may be higher than what is projected, but I suspect it's still not, in fact, it's still not as high as even what we have achieved in 18-19. So which tells me that it is at least realistic. Subject to, of course, economy, if it doesn't grow even 7%, then things can go haywire. I agree.
Okay. So let me come to some of the other direct tax changes that the finance minister has announced. These include, and Mr. Kapadia alluded to it, a reduction of corporate tax rate to 25% for companies with turnover of up to 400 crore, increased surcharge for those earning more than 2 crores and 5 crores, and bringing in a tax on buybacks by listed companies. Mr. Butani, in addition to commenting on the impact of these changes, do weigh in on whether the finance minister has done enough to increase the tax base, because that has been a question mark, budget after budget and finance minister after finance minister.
Well, I don't know if there is enough in the budget to increase the tax base. Clearly, there are no giveaways either, other than the deduction that has been given for interest deduction on low-cost housing. And there is another deduction that has been extended to government employees which are part of the national pension scheme. I think there is an assumption that has been made, which is that the greater compliance will ensure that the tax collections remain robust. Also, there are several things in the fine print of the budget, whether it's got to do with the 2% withholding tax on cash withdrawals, which is motivated largely by ensuring that you keep a trail of cash withdrawals by large businesses. But there are changes in the reporting requirements. We seem to have revisited what used to be considered as a 4x5 criteria. So just in case an individual, meets 2 or 3 of those 5 criteria that were laid down, I remember it used to be credit cards, so on and so forth. Some of those criteria seem to have come back, because now we are talking about expenditure on foreign travel, about 2 lakh rupees. Some of those criteria are coming back. So I think this is going to push particularly the non-corporate taxpayers to achieve greater degree of tax compliance, though much has been achieved post-demonetization. But I think there is an assumption that the finance minister is making that, on an overall estimated basis, leaving aside the debate that we earlier had on whether the estimates are correct or not correct, but even with the base of revised estimates for 18, 19, 11% is a fairly decent collection targets, and it could possibly be a situation of underestimating and overachieving the target, besides the point that I made on what base are you estimating the tax collections for 1920.
Okay, yes, please.
Yeah, just to supplement what Mukesh said, your question on measures for enhancing tax base, I think if we look at it in totality, there is a lot around technology, which this budget talks about. So one is this tracking of on the TDS, based on the TDS of 2%. It's a big thing because we all remember we had the banking cash withdrawal tax.
Just for the benefit of our viewers, if I can recap what the essential changes, that if anybody uses or withdraws more than 1 crore of cash in a year, there'll be a tax deducted at source of 2% above that amount.
That is right. So that is the way, because obviously if there is a TDS, you have to reclaim it.
Yes.
Right, as a withdrawer of cash.
Right.
So that gives that's a very different way of tracking cash. I was saying that earlier we experimented with the banking cash withdrawal tax, and that was quickly given a quiet burial. There were issues on reporting, etc., which banks had to do. So here, they have brought it back through a TDS mechanism. But I think, well, if it gives a trail, and if the compliance requirement is not too onerous, it seems to be a smart idea. But that is one. And if you look at it, the statement she made about allowing Aadhaar as the identity, even if you do not have a PAN.
To file your income tax.
To file your income tax return. So the other part about, as Mukesh alluded to, that basis certain expenditure, you now have to file a return, even if you may not be having taxable income. And mind you, with your 5 lakhs increase in limit to 5 lakhs and all, which was announced in the interim budget, the fear was more individual taxpayers will get off the tax grid in terms of filing. So you now see a lot of digital enabled measures for tracking, as well as ensuring that you protect the tax base in terms of the returns filed or even increase it. And one last thing I think we must pay attention to is this desire, or this you can call it policy objective, that you will have pre-filled income tax returns. I think it is only for individuals. That's a huge, it's very transformative. Because today we know that all the TDS information is available from 26AS, for example, as an income earner. So you have property transactions, they get picked up through the, now this 360-degree data which is available, and you get back a return which is, which you say, it's like property tax in cities. You get it, computation done, you have an issue, you can appeal, otherwise that's final. I think that's really transformative. So I think on individual taxation, my personal view is we will see far more transformative changes which will ensure, in fact, again, I come back to the point, you might have much more revenues under PIT, personal income tax.
Okay.
Last point is, in personal income tax, sole proprietary businesses are covered in national accounts in personal income tax. It's not just salary earners.
Okay.
So when we talk about business owners, non-corporate business owners, they all get counted in PIT.
Okay.
And besides demonetization, which Mukesh mentioned,
what is the relevance of
no, what I'm trying to say is that the increase of 22% in 18-19, which you see in personal income tax, without any increase in tax rates last year.
Okay.
How do you explain that?
Okay.
Right? I think one way of rationalizing this is that you have succeeded in increasing the tax base, the point you rightly raised.
Right.
If you deduce from the numbers, because of demon and also because of GST. Because GST has ensured that your reporting of income has certainly improved.
Right.
And that is the reason why you see an increase in the PIT.
Okay, all right. So that's heartening to hear that if you think that they have not taken any direct measures to increase per se the tax base, there are several of these indirect measures that put together hopefully will give us a better sort of base number. Let me come to one other big change that the finance minister has done, and it's going to be a heartening relief for a lot of investors coming in to bid for stressed companies. So what the finance minister has now said is that stressed assets, both which are facing insolvency and also in situations where the central government has gone to the NCLT making a 241, 242 application under Companies Act to remove the existing or suspend the existing board and appoint a new board. In both these situations, the benefit of carry forward losses would be available. The second important change in the context of stressed assets, they have said, is that the relief under on account of minimum alternate tax. Mr. Butani, before I come to the third change, which has to do with anti-abusive sort of provisions, weigh in on how important these changes are and whether they would increase the interest in of the potential bidders in these stressed assets.
Well, I think a stressed assets situation is something that the taxpayer would not wish to bring for himself. So I think we are dealing with a case of a company which is getting into insolvency, and as a result of that, in order to make it more attractive for the potential bidders, you are getting the benefit of set-off of losses and an exemption from the minimum alternate tax. So I think this is just to be able to facilitate and make it more attractive for potential bidders. Will it make it any less attractive? I think the law applies consistently to all forms of bankruptcy. So I don't think it distinguishes between a company that is, in a bankruptcy situation versus any other situation. It doesn't classify companies into small, big, or medium-sized enterprise. It just simply gives away the benefit because it recognizes that the last thing you should do to a company which is in bankruptcy is to deny them the benefit of carry forward of losses or to make them pay a minimum alternate tax.
Okay, all right. Mr. Kapadia, the most recent example that we have seen of Section 241, 242 application was in the case of ILNFS. So ILNFS group entities who probably are in a stretched situation now, I'm sure there are many other examples, will benefit from this provision.
No, I think so. Yeah, you're right. There can be many examples. Every case which comes in IBC, just to illustrate that further, by definition, you are not going to recover, you meaning the lenders are not going to recover more than 100% of what they have lent to the company. There is always going to be a shortfall. So if you think about any asset which will get sold through the IBC process, you had a situation where you would always by definition have sold less than the ostensible fair market value or the book value. Right. It's evident. That is why, because it is stressed. So I think these clarificatory amendments are extremely welcome, because that is what the industry was, positioning and saying, look, guys, we don't want tax notices. Otherwise, if we have to advise a potential buyer of stressed companies under IBC, we will have to say account for taxes.
And also that would reflect in your bid value, right?
Exactly.
If you're going to,
that's right. You account for it. Absolutely. You account for it, so it will reflect in the value, which means the lenders will have a higher haircut. So all that you are doing is transferring resources from the lender to the government upfront through taxes, which is not what was intended. So I think these were welcome changes. They have clarified whether it is MAT, whether it is loss, a carry forward, and also Section 56, not to forget.
Yeah, I was going to come to that. It's slightly complex to understand. The combined effect of Section 56 to 10 and Section 50CA, they're all just numbers.
No, so the simple point is that these sections are anti-avoidance or anti-abuse measures which were introduced some years ago. Essentially to say that if you are selling any asset at less than fair market value, then the difference will be deemed to be income, right? Because it is assumed that you have sold it or you have taken consideration of the books for the balance. Now this, as I was explaining, is something which hits IBC cases fair and square.
Sure.
Because there's no question of any, the point is you are recovering less because that's the IBC process, that's because the asset is stressed. So this basically clarifies that those anti-abuse provisions should not apply once you have a duly approved IBC case by NCLT, which is, as I said, a welcome clarificatory amendment.
And just to point out, I think they have said that CBDT will sort of put out a prescribed list of transactions, but we are all anticipating at least the IBC cases would be covered through those clarifications.
That's the expectation for sure.
Okay, all right. Mr. Butani, let me now come to the big indirect tax changes that have been announced today. I'm guessing the big one is this dispute resolution scheme to clear outstanding litigation on account of service tax and excise duty and cesses. And of course, there are some announcements related to increase in customs duty for gold, precious metal. There is some cesses and road and infrastructure, etc. But your thoughts on what is this, scheme expected to do? How much of the backlog will this clear? How will this settlement scheme work?
Well, it's a very interesting scheme. It calls itself as dispute resolution and amnesty scheme. And I could, on a reading of the scheme, figure out that it does have an element of amnesty. So firstly, it covers disputes at all levels. So in the realm of excise duty and service tax. And so even if you have a amount in dispute which is before Supreme Court as an appellate forum, it covers that as well. It basically classifies taxpayers in two categories: one where the impact is 50 lakhs, and second where the impact is over 50 lakhs. Because the corresponding relief from payment of taxes is different. It is a higher relief for taxpayers where the amounts or quantums of tax involved are less than 50 lakhs, and lower for quantums which are above 50 lakh rupees. It has a dispensation from interest and penalties. And it is supposed to be a one-time declaration that needs to be made before the 30th of June. And thereafter the scheme will apply accordingly. Now, interestingly, the finance minister spoke about over 6,85,000 crores of disputes that are locked in. It'll be interesting to see how many takers we will have for the scheme, because in one shot, the government and the taxpayers both have the potential to unlock the clogged up machinery of various appellate forums. And more importantly, if you leave Supreme Court on the side and High Court on the side, we are anticipating that as a result of the new GST law, there is a capacity gap which is existing to be able to resolve disputes that are likely to come up under the GST regime. So what this will do is free up the time of appellate forums such as CSTAT, and the CSTAT forum coupled with the new appellate forum that has been set up for GST authorities then can look at a resolution of disputes under the GST law. So it is a very, very attractive scheme on the face of it. And I anticipate that you will see, I don't know eventually what amount the government will collect. And, some of the things that we were talking about in terms of the gap of collection, I'm sure that the government would have budgeted for taxpayers coming forward and availing of this amnesty and dispute resolution scheme, because there would be collection that would happen in the current financial year. You need to tie in this, central service tax and excise scheme with a scheme which is not similar, but some of the states have initiated a similar dispute resolution an amnesty scheme for resolution of VAT-related disputes. And Maharashtra, I think, was the first state that initiated it. So you could possibly see in the current financial year, many of the states having a scheme similar to Maharashtra, though personally, in my view, having looked at the Maharashtra scheme, it didn't seem to me as attractive as this scheme. Possibly the government would have picked up clues from the Maharashtra scheme not succeeding and made at least this scheme for excise and service tax very, very attractive. Now, kindly bear in mind that the quantum of disputes that are there in the area of service tax, whether they are classification related or for other reasons, are enormous. And I think this affords an opportunity for the government to put back a history, a checkered history, if I may say so, of a very, very complex law. If not excise, certainly the service tax law of 1994, and unlock the dispute resolution machinery for the government once and for all in a fairly rapid manner.
Mr. Kapadia, two quick questions on this. That given, let's assume that I, as somebody who's tied up into litigation from the erstwhile sort of indirect tax regime, qualify for that threshold.
Yeah.
But what, as let's say somebody, a litigant, I should consider in terms of deciding or factoring in
right.
whether or not I should avail for this scheme, and also should I look at at what point of, let's say, in the appeal process is my litigation at?
Right.
What are some of those factors that taxpayers should consider?
No, I think that's absolutely right. I think when you when you strategize on this, one has to take into account what is the benefit which is being offered. The benefit, it looks like from the contours of the scheme announced, is a waiver of interest and penalties.
Okay.
Now, if it is waiver of interest, if that is what I have understood, that's huge.
Yeah.
So I really think then this is something which business will welcome, because if it means removing the uncertainty of final, of course depends on the merits of each case, but removing the uncertainty, and you asked a question depending on which stage, if it is in the courts, it will take like years to get it settled at the Supreme Court, as an example.
Right.
So whilst details are awaited, I think it's a fantastic initiative. Just to clarify, sure. I think the number we are talking of is not 6 plus, but 3.75 lakh crore.
Yeah, it's
is what she has mentioned.
Yes,
yes. So that's one. Interestingly, about the same amount is blocked also in direct tax litigation. And for maybe a topic for a different day, but what we have been discussing with revenue for a long time, revenue administration, is that the authority for advance ruling is not really functioning well for a variety of reasons. So we have really lost a very important window to have dispute resolution done or get certainty rather well in advance. When you don't get that certainty, it increases the disputes in the system. So that's, as I said, a topic for another day. But I think equally in the area of direct tax, we should look at, hopefully when the new direct tax code comes, let's look at a scheme which will address some of the legacy issues there as
wishful
well.
Wishful thinking. Let me come to the last point, Mr. Kapadia, that I want to take up. No, this offshore funds had a problem under Section 9A of the Act.
Yes.
They have provided certain clarifications, but as you were mentioning to me offline, they have probably not announced those expectations.
Yeah, so I would say 9 capital A, just to spend a couple of minutes, is
on
a
what
great,
is really saying. Exactly.
Yeah, it's a great initiative. It's been an iterative process for many of us who have been involved in discussions on this topic. It came from a very right approach of the government, NDA 1 actually, by the previous term, to say that how can we attract fund managers who invest in Indian securities to operate out of India rather than operate out of Mauritius or Singapore. That's what the starting point. So that's where we said, okay, what are the enablers? So one simple point is that you want to give certainty that an offshore fund will not create a taxable presence in India by virtue of presence of fund managers. So far so good, no problem. Obviously, revenue wanted to have certain checks and balances. One of the conditions, which is really one of the showstoppers, is that you must ascertain, and you as a fund must provide or guarantee or virtually a certification that no more than 5% shareholding indirectly in the offshore fund is of Indian residents. I think their concern is round tripping, etc.
Right.
So all that we have been saying is that, look, if you have a offshore foreign institutional fund or an institution which is approved by SEBI with all the KYC done, which is your alt AIF 1-2 category.
Yeah.
So all that has been done. Then for income tax purposes, can we just not look at that approved fund and not have this condition for those approved funds alone? That will open up a huge window for public market or listed securities, because there are funds wanting to come in and invest through this route. This gives a lot of certainty in taxation. So that clarification is what we were hoping for, which somehow has not come through. We are hoping that after further examination will come through. You are right, some other conditions they have, but this was a priority. And this is a showstopper.
But how do you then take account or ensure there is no round tripping?
No, what I am saying, there are two things. One is that in general you have to look at round tripping and any other money laundering issues. I don't think that goes away, that policing, the need to police goes away. But what we are trying to say is that, to put it differently, bona fide funds get to invest in India and get this certainty. There is no tax exemption here. It's only the certainty that by having fund managers onshore, the offshore fund is not subject to tax in India. Right? That's the only certainty, not subject to business tax in India. That is the only certainty you are giving. And you are giving it to bona fide funds. If you believe those funds are good enough to transact in India on Indian bourses, by SEBI, then why should that not be good enough? Because even there you are concerned with round tripping. It's not that you are not. So my only submission is that this is a objective which you have to address differently. Wherever you can get your tracking, your proof, etc. But for this purpose, to make 9A come to life, today you have got barely 2 or 3 funds which have been approved. So it shows that a policy has not been successful. There's no point in, leaving it that way. So that was a limited point.
Okay, all right. We've discussed the big changes that, of course, there are a lot through the, small changes through the fine print, but we've looked at the big ones. So I want to, end the show on a forward-looking point. And Mr. Butani, we're expecting the direct tax code, the draft of it to be made public soon. The changes that have come in now, are very limited in terms of their impact. In terms of the DTC architecture, now is that the next big thing that the market is looking at or investors are looking at?
Yeah, before I comment on that, I just wanted to add on the 9A point that Sudhir made. I'm glad that a law that was well intended in the 2016 budget has been revived to make it operational, because it was certainly not operational. The second is on the amnesty and the dispute resolution scheme for service tax. Besides the interest and penalty, there is also a benefit given for amount locked in litigation, and that benefit is 70% for taxpayers with less than 50 lakhs and 40% for taxpayers above 50 lakhs involved. So the benefit is not just for interest and penalty, but also for the quantums of tax involved. On your point on DTC, yes, DTC would be a big exercise. I guess the finance minister, in her wisdom, decided not to make a reference to the DTC because the committee is supposed to be or expected to be submitting its report by the end of this month. And I guess that would be a big event that would be that everyone will be looking forward to. Having said that, if you look at the fine print of the finance bill, just on the direct tax proposals, there have been several repairs that have been carried out. So I would imagine that the new code is overdue to make sure that the year-on-year repair that we carried out in our annual finance bill exercise would at least be avoided, or at least the severity of the amendments would not be as much as we have seen in the past budgets.
Okay. Final word to you, Mr. Kapadia, in terms of, I know I have been cribbing about the fact there are not enough big things, not big, big enough headlines in this, but was it fair given that DTC is in the offing?
Yeah, I don't think, frankly, one had expected any dramatic changes to the structure of the law, right? Whether you want to revisit capital gains tax, for example. Today you have different asset classes with different holding periods to determine long term. Yeah. Real estate, which is perhaps the longest term, is 2 years holding period. Debt instruments, which are certainly not as long term as real estate, you expect to hold for 3 years before it can be considered long term.
And equity, which is supposed to be long term,
you have only 1 year.
Yeah.
So clearly there is a need for harmonization and at least removing the arbitrage on holding period. I should determine my choice of investment basis other factors, not holding period. And talking about debt instruments, just to put that point in perspective, on the one hand you have this stupendous some 500 lakh crores, I have lost count, needed for infrastructure in the country. Yeah. We have since long talked about a deep corporate bond market, etc. But some of these tweaks to the capital gains structure perhaps can be big, game changers. Because I think in India there is still a great, I would say, preference for relatively, stable returns, which are relatively less risky rather than equity. So I think there's a huge opportunity there. So that's just one example of capital gains, and there could be so many else which you can't do when you're expecting a direct tax code report to come out or a draft to come out. So that I think the expectations were not there.
Okay, we'll meet at this table again, Mr. Kapadia and Mr. Butani. Thank you so much for joining us with your quick thoughts on the key highlights on indirect tax and direct tax front in Budget 2019. Thank you so much for watching. We'll see you next week.